something that you are very bullish about in the future, you want to go lower so you can buy more cheaper. The truth is, right now, if the gold price was at $2,200 an ounce, I wouldn't sell any. By contrast, if the price was at $1,500 an ounce, I would buy much more. For me personally, it is in my interest to see the gold price lower rather than higher.
Hi, I'm Kaiser Johnson with Liberty and Finance. If you'd like to learn more about a precious metals IRA, call us and we'll be happy to help you in that process. Our phone number for all orders is 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're always privileged to have this returning guest. Rick Rule, formerly the CEO of Sprott Asset Management, is now head of Rule Investment Media. He's here with us again this Thursday, September 22nd, 2022. Rick, thanks for coming back on Liberty and Finance.
Always a pleasure. Thank you for having me back. I enjoy these sessions.
Well, our viewers anticipate your arrival here with a lot of excitement because they look to you for your sage wisdom and demonstrated sort of steady outlook on changing and volatile times. You've told us over the past several visits to buckle up, volatility ahead, things like that. People are certainly seeing a lot of that. And one of the concerns that people have, if we could kind of address that theme, is, I guess I'll start it with not just market timing, but whether it's a good to get into people who are starting to get investing in, for example, gold and silver mining companies, royalty and streaming companies, that sort of thing. The sector has been beaten down for quite some time now, and people are wondering if it's such a good idea after all. And then I have a follow-up question about counterparty risk in general related to that. But first, if we could just talk about the time that we are in as far as an opportune time for people to enter into investing in mining and royalty and streaming companies.
We've dealt with this at some length in prior interviews, so let's do a recap. The first thing that an investor needs to do is invest in his or her own education, understanding about their wants, needs, and risk tolerances, and understanding, too, enough about the principles of investing that he or she has some faith in the investments that they undertake. The second is patience. Warren Buffett famously says that the market is a very impatient mechanism for transferring wealth from the impatient to the patient. Very often, I deal with somebody who says, I'm in this for the long term. And in 3 months, the value of their investments has fallen by 10% and they panic. But what on earth is long term about 3 months or 6 months, if you're right? We have discussed, Dunnigan, on prior episodes, the fact that your risk tolerance depends on your reward expectation. So for investors who are really speculators, and it's fine to be a speculator, if you are looking for very large returns, 10-to-1 returns, you must be using money that you can afford not to look at for fairly substantial periods of time, and you need to be able to tolerate at least 50% loss of principal. Further, you need to have enough psychological strength that a share price can decline by 50%, and you'll have the courage, if you understand the investment well enough, to buy more. I shared with you on prior interviews the fact that, as an example, in my investments with Ross Beatty over the years, I've enjoyed numerous 10-baggers, which is to say 1,000% returns. But those returns took 5 or 6 years to be realized. And in each of them that I remember, there was a decline in price by 50% or more during the period of time that I owned the investments. So to the extent that people get shaken out of investments now, it is due to one of several factors. First of all, they made a mistake. I've made lots of them. And on occasion, you will lose money as a consequence of your own failed effort. But much more commonly, in fact, they are a function of the fact that investors made an investment based on the old precept, got a hunch, bet a bunch, which is to say they failed to know enough about the investment that they made that they had any faith in it when they began to experience volatility. And they got shaken out of the investment simply as a consequence of their own ignorance. The third cost of failure, of course, the most common cause of failure, if you have done the work, is simply patience or lack of patience. Warren Buffett famously teaches that the ideal holding period is forever. I have never found a stock that was good enough that I was able to hold it forever. But what he's saying is, if your time period is forever, you avoid the risk of selling a good investment and deploying the proceeds in a less good investment. You're patriotic because you don't pay capital gains tax, or at least you postpone the capital gains tax. And most importantly, you don't allow yourself the advantage of compounding over time. Compounding is, of course, the eighth wonder of the physical world, but the first wonder of the financial world. So I hope that answers the question in a very fulsome fashion, because it's probably the most important question we'll deal with today.
Okay, so those are some broad principles that are absolutely appropriate. Can we put that now in the context that we find ourselves with the current market trends? I mean, you've been talking to us for several years about a secular bull market in natural resources and precious metals, but then we've been having a bit of a intermission for the last year and a half or so. Can you talk to us about where we find ourselves and now applying those principles that you just enumerated?
Well, I would point out that the intermission has only taken place in precious metals. In other parts of the resource industry, including the oil and gas industry, which you and I talked about in depth a couple of years ago, the response has been spectacular. The uranium industry, despite a bit of a malaise, has also performed very, very, very well over the last 3 years. The precious metal sector is in a malaise, and I think in the very near term probably continues the malaise. The U.S. Treasury, or pardon me, the U.S. Fed has rightfully, I think, allowed interest rates to rise. You need to compensate savers for inflation. The fact that they have been able to do that, particularly when their counterparties at other central banks around the world have not kept pace, has meant that the U.S. dollar is very strong. So while gold is doing extraordinarily well in terms of currencies, like, as an example, the Turkish lira or even the euro, in dollar terms, investors have done poorly, while in terms of other currencies, they've done well. Most of your listeners, of course, spend dollars, so it's the dollar returns that are problematic to them. My suspicion is that if we are able to continue to raise interest rates in the United States, that the dollar will continue strong and gold and silver will do poorly. I believe, but I don't know, that at some point in time, the Fed will be forced to reverse course on interest rates, because any reversion of interest rates to their real mean, which is to say a positive real rate of return, would, I believe, be devastating to the U.S. economy. And I suspect that to the extent that the Fed has to resume liquidity measures and has to lower interest rates, that you will see then, like you saw at the end of 1975 or like you saw in 2002, precious metals off to the races. Note that I said that I sort of presumed that's my suspicion. I believe that some of your listeners probably have 100% of their net worth in precious metals, which is not a very smart thing to do. I think that investments in any category need to be right-sized to your means and to your needs. For me personally, Dunnigan, I welcome lower precious metals prices because I continue to be in the process of acquiring physical precious metals and precious metals equities. And something that you are very bullish about in the future, you want to go lower so you can buy more cheaper. The truth is, right now, if the gold price was at $2,200 an ounce, I wouldn't sell any. By contrast, if the price was at $1,500 an ounce, I would buy much more. For me personally, it is in my interest to see the gold price lower rather than higher. I realize that my psychological circumstance and my financial circumstance is different than the circumstances that many of your viewers enjoy. But I'm trying to point out the attitudinal difference between myself and other investors. I am not disappointed by lower gold and silver prices. I'm attracted to lower gold and silver prices because I don't need to experience a liquidity event in the next 10 days, either financially or psychologically.
If we could now broaden out the concerns that people have about investing in basically anything that involves markets or brokerages or exchanges or that sort of thing in the current environment, there's some concern that, as we've discussed, everything we've discussed has to do with moving your pieces on the chessboard in the right direction in the right time, and then waiting patiently for your move to play out, that sort of thing. But there's some concern, and perhaps it's credible on the part of people, that the entire chessboard might get knocked right off the table if there's a convulsive collapse of the derivatives, or if there's a credit liquidity crisis that causes brokerages to get to suffer as Lehman Brothers did once upon a time, or so on. So could you address that kind of, I don't know if you want to call it systemic, existential risk that might be kind of overarching beyond the sort of stock picking and market timing?
I think that existential risk is a possibility worth considering, but I don't consider it to be a probability. And I don't consider it to be a probability in the near-term time frame. I think that the system will more likely than not, experience exogenous shocks. But I also think that the costs imposed on you to have too many of your financial assets outside of the system, both in terms of the availability of investment alternatives and the ease and cost of employing these alternatives, mean that insuring against the contingencies of a total system breakdown should probably be confined to survival limits, which is to say, if you're worth $1 million, as an example, perhaps, I'm not saying that you do this, perhaps you should invest 50,000 of that in precious metals and ammunition, because in the event of a total system breakdown, ammunition will be at least as important as physical precious metals, and store that in a way that seems appropriate to you. I don't think, as our system is currently configured, if you are an investor with a reasonable sized net worth, that you invest too much money in a contingency that's a possibility rather than a probability. If we see a circumstance where existential threats to the system are more expressed, the amount of money, I might say unfortunately, that we will make on in-system investments in assets that would do well in times of panic would be extraordinary. And my suspicion is that if you had the courage and the foresight to recognize that circumstance, that you could liquidate your on-market investments and redeploy that capital off-market as the circumstance warranted.
Well, we would hope that door will be open for people. There's certainly been times I remember with displeasure. I remember getting a letter from my brokerage, TD Ameritrade, saying, until further notice, you will not have access to your funds that were in this so-called money market account called the Reserve Fund, because it was collaterally damaged by Lehman Brothers and all this, even though I was only in it for the 2%.
Well, certainly that wasn't the system's fault. That was yours. You invested in a money market fund that was leveraged. You thought that you were in a cash instrument. A cash instrument would have yielded you 40 basis points, and you were receiving 200 basis points because of leverage. When the overnight capital markets froze and your money market fund no longer had access to credit, your money market fund blew up. But Dunnigan, you need to understand that wasn't the fault of the system. That was the fault of Dunnigan.
It's true that we had been limping along at a small fraction of a percent of in an FDIC insured Treasury backed account until we finally asked our broker, isn't there something we can do to get a little bit more interest while we're sitting on the sidelines? And this was a suggestion that we took them up on, but did not dig into the prospectus to see how it was that they were able to offer those higher rates.
Remember the ex-President Reagan's wonderful quote, "Trust but verify.
So there may be quite a few people today in boats like I was in, and my wife were in, where they're counting on annuities, they're counting on guaranteed returns from insurance products or that sort of thing for their retirement and income stream, et cetera. Your thoughts for people who may be assuming that the next 20 years looks like the last 20 years as far as their overall risk posture?
Dunnigan, the first part of this interview, I said that the most important investment that people could make was in themselves and their own education. It amazes me that people blindly trust the brokerage industry. I come from the brokerage industry. That trust is miswarranted. People blindly trust the Securities and Exchange Commission. And while the Securities and Exchange Commission has very good people employed in it, in the industry, we laughingly call it the Swindler's Encouragement Committee. The SEC did not protect you from Enron. The SEC did not protect you from Bernie Madoff. The SEC only really seeks to protect the industry from a lack of public trust. It's important to participants in investing, whether they want to or not, to understand that the only protector of their wealth is themselves. When I operated a brokerage firm, I had to negotiate a clearing contract with another larger brokerage firm. There were 16 brokerage firms on offer that offered this type of service, and I need to tell you that even as somebody who is relatively expert in financial statements, balance sheets, and income statements, at least 12 of those 16 potential counterparties had balance sheets that were, to me, incomprehensible. I was unable to trust client funds to counterparties that I couldn't understand. Most people don't take the time to read the balance sheets and the income statements of the institutions that they trust with their money. A bad outcome is precisely what those people deserve. The idea that they believe that somehow Big Brother, Big Daddy will protect them. The idea that they seek to be protected by government when they should be seeking to be protected from government. I know this sounds heartless. Well, another great quote from Pogo, the cartoon strip character. I have met the enemy, and he is us.
As true as that all is, it does seem unrealistic to me to think that the majority of ordinary mom and pops in the USA are going to develop that kind of almost expert, or you even said at a fairly expert level yourself, it was daunting, ability. So they need to be able to trust, and you've talked about this in the past year about sort of branded conclusions or outcomes, that kind of thing. They need to know who they can trust without having to become an expert in everything. It's very ironic, and I guess this is symptomatic of an overall breakdown in trust in our society. I would say that the institutions that people typically did trust have proven themselves untrustworthy in extremely important ways. That whether that's government, whether it's the press, whether it's medical establishment, on down the line, education, etc., have been letting people down hard in recent years, and it just isn't realistic, it seems to me, for people to be able to carry on their ordinary lives and become expert in all those areas. So if I'm right that that's not realistic, then what are some strategies? For example, you got involved in this formation of a new bank because you want to do better for people than they're getting, because you found you're also a disgruntled banking customer yourself. So let's just start there with people who don't have the time, inclination, or perhaps even the aptitude to really master understanding whether or not their funds are safe at their local bank or whatever. Where can they turn? And I'm not trying to serve you up a softball here, but you certainly have thought this through. Where can they turn for reliable advice if they can't trust their banker and they can't trust their government?
There are many good banks in the United States. There are probably more bad banks, but there are many good banks. I would say that investors should shy away from any bank that has excessive derivative exposure. Derivatives are wonderful instruments if you use them as a banker to shield yourself against moves in interest rates. In other words, if you use them as a hedge. But banks are using them as trading positions. And I don't think that the bankers, although they're very smart, are smart enough to maintain balance sheets that on a notional basis are as large as they are. The simplest way for investors to look at a bank where deposits are safe is, first of all, to split their deposits among various institutions in amounts less than $250,000, which is the FDIC guaranteed limit. Will the FDIC ultimately succeed or fail? I don't know, but it's a great first step. The second thing, however, is to get a list from the FDIC or your state banking regulator of banks in your state ranked by equity as a percent of total assets. The FDIC considers a bank with 7% of equity to total assets to be well capitalized. I personally prefer 10. In other words, I want a bank to be, from the point of view of the FDIC, over-capitalized, particularly if I'm a depositor. There are several banks that I know of in the United States. Farmers and Merchants Bank of Long Beach comes to mind. First National Bank of Alaska comes to mind. Bank of Hemet in California comes to mind, where equity as a percent of total assets is between 15 and 20. Those are banks that are historically well capitalized and safer places to trust your money. Many investors simply look at the Wall Street Journal and they try to find the highest deposit interest rate that they can find, which is invariably from the bank that needs the most money, needs the money the most. Safety is probably inversely correlated many times with yield. In our own bank, which you mentioned, this experience goes to several things. It goes to the fact that I'm personally a large customer of 3 mega banks, and my relationship with all 3 banks would be best described as sullen rather than mutinous. I want my relationship with a financial institution to be ecstatic, not sullen. I had a very large U.S. bank when I transferred from my California branch to my Washington branch when I moved that lost my trust documents. And it became my problem to replace the trust documents that they lost, despite a very, very large credit balance. When I made application at the bank to understand some of their deposit products, rather than having anybody at the bank who could tell me anything about deposits, they gave me a little white phone to call their headquarters, where I was promptly placed on hold. That's not sufficient for me. Those same banks have derivatives exposure that is beyond my ability to comprehend. As a consequence of the fact that I am uncomfortable with my banks, despite my apparent sophistication, I assume that that condition extends across the length and breadth of the country. Backstory, in 1998, I backed a team that created one of the first internet banks in the United States. It was called EverBank. And it succeeded beyond my wildest dreams. The bank grew over 14 years from zero, was in fact started on my living room floor, to $28 billion, and we sold it to TIAA-CREF. We did it because our non-interest expense was very low. We had no branches. And as a consequence of having no branches, and as a consequence of the fact that we marketed through the financial newsletter channel rather than through display ads, we had a marketing advantage and we had a non-interest expense advantage that allowed us to pay at in the top decile of deposit interest rates for institutions nationwide, while still being competitive in our lending and still generating sufficient returns for shareholders. Amazingly, after 20 years, the opportunity exists to do it again. The banks all tend to rush towards vanilla product. That bank, EverBank, and our new bank, Battle Bank, intends to develop deposit products that are useful to customers. As an example, there won't be 13 different savings and checking accounts. There will be one. You can write checks on it if you want to. You don't have to if you don't want to. And it will be in the top decile of interest rates for current accounts offered in the market. But if you want a CD, you'll be able to get a CD that's gold or silver indexed. You'll be able to get a CD denominated in Canadian dollars or in euros or in Swiss francs. So if you're a Singapore businessman doing business in the United States and need some of your money in a product that's denominated in US dollars rather than Singapore dollars, we'll be able to do that. The other banks could do it. They just won't do it. Conversely, Donegan, and you'll love this, if you are a holder of physical precious metals, not in your own possession, but rather at some place like Loomis or Brinks, where I know that Miles Franklin allows storage, you will be able to borrow against your physical precious metals holdings. And you'll be able to borrow at competitive rates. So if you want to borrow to buy more gold or silver, that's available. If you are temporarily gold rich and cash poor, and you want to put down the down payment on a summer house or something, you'll be able to do that. There are these enormous holes in the market that exist, I think, because the financial services institutions have been protected from true competition by the Fed and by the ignorance of the market that 20 years ago allowed us to build a bank from $0 to $28 billion and will likely allow us to do the same thing again for the same reasons.
If we could rotate our discussion to a global perspective on this dynamic that's been described as the East-West split or the Asian Bretton Woods, where the dollar dominance that has been present for the last half century or so seems to be under actual threat by Eastern countries that have decided that they would rather not be penalized if they don't march in lockstep to whatever Washington thinks that they should or whatever Europe thinks that they should. So how do you see that evolving, and how do you see that affecting investors? Conflicts aside, like there was this whole thing with Russia, Ukraine that made us talk for somewhat about Gazprom specific stocks in Russia, but that's not, I'm asking about, I guess, a broader question about this whole geo split between the East and the West and how you see that affecting the landscape going forward.
I do see the threat that you described, although I think it's important in terms of understanding the threat that we more properly describe the genesis. This isn't Russia or China or India weakening the U.S. dollar as the world's reserve currency. This is the U.S. weakening the U.S. dollar as a reserve currency. We have chosen, first of all, to debase our own currency with $30 trillion in on-balance sheet liabilities and $120 trillion in off-balance sheet liabilities. Places like China that generate surpluses are rightly asking themselves why they should accept 300 basis points in interest in a currency where the purchasing power is depreciating by 900 basis points. In other words, why should they give up 6% of their purchasing power per annum to a country that is hostile to them? Then the United States has chosen to weaponize its currency. While we accuse the Chinese of being expansionist, and they are, it's worthy to note that the United States maintains a military presence in 100 countries around the world, while the Chinese maintain a military presence in 4. The idea that the United States has decided to extraterritorialize its preference, telling other countries how to live, telling other countries how to organize their societies, while in some cases admirable, obviously is inconvenient for the countries that the United States is bossing around. By freezing Russia and China and India and other countries out of, or threatening to force them out of the SWIFT banking system, we give them no choice but to denominate trade between themselves in mediums other than the U.S. dollar. Blaming the Chinese, blaming the Indians, blaming the Saudis, blaming the Russians for doing something that we forced them to do is at once disingenuous and ignorant. We need to understand that we are the authors of our own demise. And by the way, I think it'll take a very long time to destabilize the U.S. dollar. My experience over the last 30 years is that as little as other societies trust each other, they still trust us more than they trust each other. And I believe that the U.S. dollar, despite its threats, will continue to be the world's reserve currency for a substantial period of time, despite the best efforts of the United States to undermine its own status. It is really important that your listeners, when they consider the destabilization of the dollar. Don't let the big thinkers in the United States, be they Democrat or be they Republican, to blame the Russians, the Chinese, the Japanese, or the Indians. You need to point to the demise of the U.S. dollar as a spending or savings medium or as a medium of exchange. You need to point the finger of blame at the United States.
These decision makers who have mismanaged the U.S. dollar from 1913 to the present, where it's lost almost all of its value, purchasing power along that way, especially accelerating after the closing of the gold window in 1971, etc. Do you see that as the United States itself, the United States government, or do you see that as part of international banking that transcends the United States and always has, even before the formation of the United States?
I think the most important financial institutions and international institutions are America-centric. I'm not one of those who believes that there's some overarching conspiracy involving the Bilderbergs and the Rothschilds and all that kind of stuff. I don't see that. I see there being a globalist fascist class, certainly, with common interests, and I see it being American-led.
Speaking of America, maybe you meant broadly there, because you spoke with us quite sharply after the actions that were taken by Justin Trudeau in Canada that were fascist in response or retaliation to some protests that happened with truckers, et cetera, up there. What is your assessment of the state and the trend of fascism as you see it, both in United States, in Canada, other countries around the world? Where are you encouraged? Where are you especially concerned?
I define fascism as government controls as the lever of the market and the reliance in society on coercion rather than convincing people. Companies must convince people to buy from them. Companies must convince people to go to work for them. Companies must convince people to own their shares. Governments find convincing inconvenient, so they regard coercion as being preferable to convincing. So any place in the world where government is on the ascent is, by my definition, becoming more fascist. Many of your listeners won't like that because they believe that they have the right to politically prevail against others who don't share their views. And they regard a government that compels people to adopt their views as being right and proper. Even if government does my bidding, if they do it by force or threat of force, I regard them to be fascist. I believe that any system that maximizes compulsion, maximizes coercion at the expense of choice is by definition fascist. Unfortunately for me, I don't see very many places in the world, with the exception of places like Liechtenstein, which is not a viable option for many people. I don't see many places in the world where government is in retreat. I see places in the world where the private society is still dynamic enough that you can make money, enough money that you can outpace the aggressors. I think the United States is one of those places. For all of our faults, we're still a society with enormous private resources. We're still a society with enough aspiration and enough intellect. And we've said this before, that a group of kids can commandeer a garage in Sunnyvale and out pops Google, where individual initiative can still finance our collective stupidity. So I'm actually an optimist, despite the fact that I'm discouraged by most people's belief that the nanny state could and will do their bidding.
What suggestions do you have for people who, living in the United States, want to benefit from those opportunities that you just outlined, and yet want to minimize the overbearing overreach, the compulsion and coercion and everything of government, and the intrusion in their privacy, et cetera? Any thoughts you have for people on increasing their privacy, increasing their freedom while blooming where they're planted?
Well, the first is that your biggest risk will always be to the right of your left ear and to the left of your right ear. It isn't going to be Biden. Your biggest risk is always yours. So alter the things that you can change. Save. Most Americans don't save. You may consider Starbucks or Budweiser or a nice car to be a necessity. It's a want, not a need. Save 10% of every paycheck pre-tax. Don't tell me you can't. Do it. If you can't afford an apartment, become a roommate with somebody. If you can't afford a new car, take a bus. If you can't afford a Starbucks, pay yourself first. 10% of every paycheck pre-tax. Save. Maintain liquidity, even if some of that liquidity is costing you purchasing power. Understand that having cash available to you diminishes your purchasing power by 5% compounded. If we have a liquidity event, if we have a panic in markets similar to 2008, having that cash will give you the tools and hopefully the courage to take advantage of that situation rather than being taken advantage of by that situation. Invest before you speculate and invest for the long term. It's important that you chase very high returns, which always have very high risks, with money that you can both financially and psychologically afford to lose. Now, Donegan, I didn't do that. I speculated before I invested. And I got very, very, very lucky. And when I think back to what I did, I thank my lucky stars that things worked out the way it did. Most people should not do what I did. It's like that YouTube video. Don't try this at home, folks. Invest before you speculate. Know enough about your investments that you treat volatility rather than a test of faith as a series of sales. I think that's what people have to do. I've probably run into 1,000 people at conferences over time who said, you know what, I don't even try anymore. You know, Donald Trump is going to wreck the country, or Obama is going to wreck the country, or Biden's going to wreck the country. They use their fear of big thinkers to excuse themselves from the obligation to look after themselves. In other words, they consign themselves to failure. I remember somebody once asked Michael Jordan how he scored so many points. So, well, I took a lot of shots. You know, all that empty air between him and the basket didn't matter. It was him and the basket. So don't be focusing your attention on Biden. Don't be focusing your attention on Trump or Obama or any of those big thinkers that you despise. Those things are all beyond your ability to control. Not spending wealth on discretionary items is within your ability to control. Not speculating when you don't understand enough about the speculation that you can afford it financially or psychologically. That's within your control. Reading a contract when you buy insurance. Reading a contract when you deposit money. Yes, it's boring. There might be 40 pages. That's within your control. It's weird to me that people might spend more time researching a $200 item, deciding whether to buy it from Walmart or Costco, than they do buying life insurance. But that's the way people are, and it's a recipe for failure. People say to me, but Rick, I don't want to live like that. Well, I don't really care how you want to live. In fact, the only one who cares how you want to live is you. And you need to step up. And you need to take control of your destiny. Otherwise, the government will do it for you, and the outcome will not be pleasant.
Any further tips on maintaining your privacy in an environment in which it seems like that's becoming increasingly difficult?
Privacy's gone. I mean, privacy's gone. People say to me, why are you so public? And I say, if they want to know about me, they have access to it. I mean, in terms of living a convenient life, in the United States, privacy is history. If you have a cell phone, your privacy is gone. If you have a bank account, your privacy is gone. If you don't pay tax, you're probably gone. You're going to become a guest of the state. If you do pay tax, your privacy is gone. It's too late.
Well, all right. In an era where privacy is gone, there's still the element of freedom to act without being blocked. Are there certain actions or courses of action that you see that tend to preserve your ability to make choices and make decisions rather than losing those choices and decisions and having them made for you by others?
I think your own education. I think deciding whether you should pay a 200 basis point management fee on your IRA or a 50 basis point management fee on your IRA, organizing your life around things that you yourself can control. That's the most important thing. If you spend a whole bunch of time fearing stuff that you can't control, what happens is that you get frozen into inaction. You use it as an excuse for procrastination. And you're unilaterally disarming.
And it's not helpful. It doesn't produce a good outcome for yourself as well, besides being emotionally distressing. So
correct.
Well, okay. So this has been very interesting because we didn't do the usual discussion of topics as much. I mean, current events or anything like that as much as we did. Talking about principles that I think people can really see how they apply to their own lives. If people do want to take advantage of any of the offers that you've provided in the past, are any of those still available? All
still available. If you care about my thoughts on resource investing in particular, if you go to a website, ruleinvestmentmedia.com, you can enter your natural resource stocks in our database, and I will personally, for free, rank them, 1 being best, 10 being worst. In addition, Dunnigan, now that the market is risk off, I'm risk on. I'm going back into the private placement market because others aren't. If you're an accredited investor and you care about what I do with my own money in private placements, I'll tell you for free. In the question and comment section on the rankings database, enter placements. Remember, only accredited investors, but there's no charge for the service. Finally, if you're interested in my new bank, Battle Bank, if you're interested in an institution that can pay in the top decile of deposit interests, if you are interested in a bank that make deposit products that are suited to you, and a bank that will lend against precious metals and other viable collateral, in the question and comments section of the Rule Investment Media database, write bank, and I will send you back your rankings. I'll put you on the placements list if you qualify, and I will certainly put you on the list that will allow you to become, as soon as our charter is granted, a bank customer, or if you qualify, a bank investor.
Well, we're always grateful for those offers. I know I've taken advantage of the portfolio ranking, appreciate that. And our viewers have as well, to the tune of many, many hundreds, it sounds like. So grateful. If you haven't taken advantage of that, folks, it's free. So don't hesitate. And also, just so you don't miss a single episode with Rick or any of our other guests, make sure you go to libertyandfinance.com and sign up for our free newsletter. You'll get 1 email per day in your inbox with our latest interview and any of our weekly specials by going to libertyandfinance.com, putting in your name, email address, click submit, and make sure you confirm with the confirming email you're opted in. That way you'll get on our email list. Rick, as always, on behalf of all of our viewers, just thank you for joining us on Liberty and Finance. We look forward always to these visits together, and we always learn something. Many people say they have to watch the interview twice to get all that they need to get out of it. And I feel the same way. So thank you so much for being with us and sharing your experience with our viewers.
A pleasure. Thank you for the opportunity. I hope some of your listeners will decide as a consequence of this to take control of their own financial future.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.